What's up, guys? I'm filming back to back right now, so I'm gonna go ahead and start. Like I said, this right here is kind of touching the border, not crossing the line, but this is not financial advice right here. I'm giving you information. This is information straight from my textbook of my Series 7 top off exam. So let's get into it. So you guys may be wondering, well, let's see about investing in real estate. Now you might say, well, if I invest in real estate, I don't have the money to buy a duplex, a house, etc. I don't have the money to do that. Well, cool. You can start out a little smaller in the stock market. So there's a thing called REITs or REITs or real estate investment trust. So you're wondering, well, what is that? Well, I have the book right here, so it comes straight from the book, not from my mouth, not from my thoughts, straight from the book. So real estate investment trusts are companies that manage a portfolio of real estate properties to earn profits for their shareholders. So they invest in office buildings, apartments, nursing homes, shopping centers, you name it. And they may invest in long-term mortgages, own real property, or invest in each other. So now you're saying, well, okay, so basically I'm investing in an investment, what you are. So real estate investment trusts, there are three types. You have equity, mortgage, and hybrid. So to break it down in simple terms for anybody to understand, equity, they take equity positions in real estate. So when you invest into an equity REITs, you receive income from the rents received and capital gains when it's sold at a profit. So when the property is sold, you get that capital gains. As a shareholder, you receive income from the rents received. It's like a dividend. Mortgage REITs. They lend money to building developers and pass the interest income to shareholders. And they're highly leveraged, which means a high amount of debt in relation to equity. Now you may be wondering, well, if you have a high amount of debt, don't you get a tax shield, right? I mean, we learned all that if you're a finance major. Well, yeah, but this is not really for a company. This is more of for investment. So worry about the investment. It's not a company. It's an investment. So you can take that away. And hybrid REITs are a mix of equity and mortgage. So you're investing in two pools. Now, the greater that diversification of any investment, it's probably better as a security blanket instead of putting all your eggs in one basket. Just remember that. Now, remember, this is not financial advice. This is just information I know, information I learned from school, information I learned from this textbook right here, Series 7 Top Off. And other facts and characteristics of real estate investment trusts. The IRS rules, this is IRS rules now, it's not from me. It requires that real estate investment trusts, pay out at least 90% of their income to shareholders to qualify for tax exemption at the trust level. So therefore, hey, they want to be tax exempt, right? They're going to give you 90% of their income. And real estate investment trusts must have at least 75% of their assets. So whatever they're investing in, the buildings, nursing homes, shopping centers, apartments, whatever, 75% of it must be in real estate related activities. So that's what's called real estate investment trust. And it says if the real estate investment trust satisfies these requirements, it avoids double taxation because it doesn't pay a corporate tax. So you're saying, okay, so I'm investing in investment of real estate. Cool. What does it do for me? Well, it can provide you income, diversification, professional management, and growth. See, you're diversifying because you're in real estate now, and you could be in one office building, one apartment complex, one shopping center. You can go to different areas of real estate. And you don't need a specific net worth or tax bracket to invest in this. You could just go ahead and get one off your app or wherever you invest in. And it's an income equity security because a lot of investors that invest in REITs generally want income and capital appreciation. So it's not a debt security, it's an income equity security. And real estate investment trusts do not, it says it right here in the book, do not provide investors with depreciation write-offs, and losses are not passed down through to investors. So whatever that REIT is investing in, that office center, that nursing home, that shopping center, wherever it's investing in, if there is a loss on those properties, they do not pass it down to you. You are A-OK. You are covered from having that loss. Now, I'm going to get in a little bit more. It says the advantages of investing in these REITs You have appreciation in property value, which is obviously going to drive up however much money you're going to make back. Dividend income, liquidity, because you obviously can sell your shares. You don't got to worry about them being held. Increased demand for real estate. So obviously, more people that invest in this, the more that real estate goes up. People are like, man, I want to invest in real estate now. So more people, more demand, and obviously more money is going to flow in. An increase in occupancy of rental property. So if you have an apartment complex you're invested in, hey, more people can come in there and say, hey, I want that real estate. More money for you. And then there's a disadvantage too. Not just going to give it the good things, give it the bad things too. It says a decrease or weakening in demand for real estate would negatively impact, REITs. So whenever real estate demand goes down, no money's coming in because people are like, man, I don't want to invest in that. I don't want to go there because real estate's too much. So then the decrease in demand of people wanting to be in real estate is like, nah, it's going to end up dropping the REITs down. And it says an increase in interest rates, thus an increase in mortgage rates, would not be advantageous to REITs. So that means no advantages go to REITs, because if you increase interest rates, less people are going to want to take out a mortgage. Less people are going to have to invest inside of their home. Less people are going to be homeowners because they're like, man, rates are too high. Why would I get a mortgage? So therefore, disadvantage to REITs. And then overbuilding. If you have 1,000 complexes and only occupancy rate is 10%, so I have 1,000, 100 people are there. So that means you got 900 available units that are vacant. You just overbuilt. So therefore, you're losing money. That means your REIT's losing money because you are not covering the cost of that building. That's simple math. That's simple knowledge. So the book's telling you there are advantages and disadvantages, but mostly the advantages outweigh the disadvantages. So just remember, overall, REITs are a very safe investment. Now the book says it. The book says it, not just from me. The book says it. They are generally a safe investment. Losses aren't passed down to you. And if they want to avoid that taxation and be tax exempt, 90% of the income got to be passed to you. And besides, you're investing in real estate because they've already invested. So that's real estate investment trusts. So you can make your decision to invest in them, yes or no. I'm not telling you to invest. I'm just giving you a whole bunch of information from the book because not many people understand what a real estate investment trust is, let alone a sector one. So you have different sections of real estate, but now you understand what real estate investment trusts are. So this is just informative. This is information. SEC firm, don't come after me. I'm not giving financial advice. I'm just telling them what your book says. So that concludes today's episode, guys. Thank you for learning about real estate investment trusts. If you got any questions, just let me know. And on to the next episode.